My name's Chris Lester. I want to thank all of you for being on the call today. I've been doing these calls now for a little over, I guess, 9 months now since COVID hit. And, I really do look forward to reaching out and seeing and hearing from each and every one of you. COVID is starting to spike again. We may be in for a new wave. I'm not a gloom and doom kind of guy. I'm a glass half full kind of guy, but we were talking about back in April when we were looking at projections that the forecasting that Morningstar had done had shown that we were going to quite possibly hit that wall, and it looks like there's some definitely hot spots that are springing up. So, a lot remains to be seen as to where and what happens going forward. But today's call is going to be surrounded around target date funds. Now, before we get into that, some of the folks that are on this call may have been invited by another advisor. We belong to a network or a group of advisors, and we're all like-minded in our approach. So if you were invited on here and you have questions after, today's call, these calls go 15 to 30 minutes, depending on the topic. We're going to invite you to circle back with that advisor and see if they can answer your questions. If for whatever reason they can't and you want to reach out to me, I have an open door policy, so feel free to do that. So target date retirement funds, if you've not heard of these are also known as life cycle funds. In the federal employee marketplace, they're given as an option. And here's a Reader's Digest version. Target retirement funds are designed to be the only investment vehicle that an investor uses to save for retirement. So they're also referred to as life cycle funds. That's what the TSP for the federal government uses, or age-based fund. And the concept is simple. Pick a fund, put as much as you can into that fund, and then forget about it until retirement or until your retirement age. Of course, nothing is ever as simple as it seems. While simplicity is one of the pros of these funds, investors still need to stay on top of fees, asset allocation, and the potential risks. So, target date retirement funds here, if you look Q1 of this year, 2020, it was approaching $2 trillion of funds going into that. And there's been a steady flow of going into these vehicles. Now, what I find interesting is that part of the whole concept is once you pick a fund, so the way that they're designed is that they will have a date. So let's say that the date we're looking at is 2035. That is the year you decide you want to retire 15 years from now. Ideally, when you have more time, it would dial and have more equities. And then as you got closer to your retirement date or the date of this fund, in this example, 2035, they would start to be more heavily bond weighted and less equity exposure. So therefore, the idea is to reduce risk. But there's two fundamental flaws that are happening with these types of accounts. The first is human nature. By design, these are designed to be passive holdings, and they go up and down into, like I said, they auto dial or auto adjust. But you can see now that funds as far out as 2035, then in March of this year, right, you see 2025, 2030, 2035, that orange bar dropping down, people auto overrode the ability and pulled out and moved to cash. I mean, that's alarming. It defeats the purpose. And this is why most investors end up falling way short of potential returns because of emotions, right? It's very hard to be robotic. And as simple as these sound, they don't always work tried and proven. So the second challenge is they all follow something called the glide path. And these vehicles since the 80s, I'm sorry, the early 90s, late 80s, early 90s, when they were first created, right, were designed in an environment where interest rates were 6 to 8%. However, we know we are not in a 6 to 8% interest rate anymore. So again, what starts to happen is as the bonds approach the target date, right? So, 2020, 2030, 2040, whatever, that they are going to have less of an exposure into equities and move more into a bond holding portfolio. And there's all the major firms have some version of these. Not only do I think they're expensive, but the auto adjusting does happen. But what you have to understand is that we are at the tail end of a 30-year secular bull bond market, right? That's a mouthful. 30-year secular bull, which means, hey, we're raging in growth bond market. You now see after 30 years, the blue lines have tailored down to, negligible rates right now. So when we forecast out is to, bonds should be part of a portfolio. And believe me, I believe that we should have balance and diversification, and bonds make up a good component of that, right? But right now with our low interest rate environments, and that's a very key measuring component right now, is because if we're in a low interest rate, right? And if you're curious as to what a 30-year bond might look like, you just go and say, what's a 30-year fixed rate right now? And we're probably around 3%. I heard it drop below 3% recently. Some clients have called me to refinancing, but that always sort of gives you a pulse check on what long-term bond holdings are. So think about what they're doing. They're moving assets automatically as you get close to this target date into a bond holding. When they were originally designed, interest rates were 6 to 8%, and now we're in, let's just call it 3% environment, and saying that's the best place for money to reduce risk. And the flaw with that is that we are trading in a cheap asset for an expensive asset. What do I mean by that? So typically, if we were in, the S&P 500, and when you're looking at stocks, and part of the way you measure stocks is its PE ratio, price to earning ratio. And right now the S&P is, roughly would be about 22 to 1, right? So that's the earnings that the S&P price would be generating. And what we're doing is getting rid of that less expensive and going out to a bond and replace the E with the I for interest rate. And so that's trading at about 135. So 135 is more expensive than 121, and it's not a good trade-off. But let me put this into simplified terms, because this is a slide I've been showing for years. When is safe not safe? So this is from Vanguard's target date fund of 2010. So, if you were to own and start to be more heavily bond laden back in 2008, 2009, right? You see it on October 1st of 2007 that the shares of this target date fund were trading at $23.99. Within 2 years, the bottom fell out and lost almost 35%. 1 year before retirement. So let me put that into, let's say you had $1 million portfolio and you just lost $350,000, or your account value was $650,000 a year before you retire. That's the problem and the risk, and that has happened in the past. And again, I caution that when you put things like this on autopilot and think that everything's going to be fine, everything's okay until it's not. So I just caution that, hey, using, professionals, getting professional opinions, doing risk assessments, having a strategy, all these items are prudent in dealing with your long-term financial picture, right? I'm not saying that, hey, listen, there are times when the target date funds can work and they are simple, but you also get what you pay for, right? So, and these are no bargains. You look at some of these expenses and some of these, and they're as high as 2%. So you look at this and you go, wow, is that really the risk that we should be taking as we approach retirement? So we're all about, just reducing risk and getting a second opinion. So folks, it is a simple topic today. It's just that we hear terminology, and I just wanted to make sure that you guys understood how these work. There you are, called a couple different items, but again, if I can help you in the future, let me know. Here's our disclosures. Here's our, my RIA disclosures. And ultimately, if you do have a question, please remember to reach out to the advisor that invited you on and thank them and run it by them. If not, please reach out to me. I want to thank each and every one of you for taking time out of your day to be on this call. And again, don't keep us a secret. Look forward to seeing you. Have a great day, and thank you. Bye-bye.